Right, for our next session, tough act to follow from value to quality investing. Andreas van der Horst from Mazi Asset Management. Andreas, you've seen that one slide from Sean on how valuations managed, but you're all about beating the MSCI while managing risk in the Mazi BCI Global Equity Feeder Fund. Thanks for your time this morning. Thank you for coming on. Looking forward to your presentation. Thanks.
Eugene and our 700 participants, thanks again for the opportunity. Sean's always a tough act to follow and a masterclass. We last spoke in May at the BCI Global Conference, and today we'll kick off with our performance figures. Then we'll briefly talk about what we do and how we do it, and then devote the rest of our time to 3 of our winning investment ideas. So let's crack on. Got the performance slide up. These are the ASISA numbers through the books to the end of June 2024. On a 1, 2, and 3 year basis, we are nicely ahead of the equity. We've delivered compelling first quartile performance, well ahead of our ASISA peer group. We've done 19.5% on 1 year, 33.2 over 2 years, and 14.6 over 3 years. Our alpha figures are 3.8%, 8.3%, and 0.3%. And these numbers are after management fees of 80 bips, no performance fees. Next slide, please. Let's pause for a moment and focus on what we want to achieve. What do we do at Mazi? What do our performance numbers stand for? We want to balance 2 central elements: deliver an above benchmark hard currency return over the medium to long term, and manage risk by avoiding the permanent loss of capital. We need to be very clear about the task at hand so that we can focus every day on our investment process. Next slide, please, Dan. How do we deliver? Thank you. How do we deliver a repeatable benchmark beating performance? We take 3 steps. We search for the best companies in the world. To be clear, not fair companies at wonderful prices or the next speculative thing. We're looking for those companies that have already won and will continue to win. When we find them, we buy these businesses at the right price. Valuation matters tremendously for exceptional long-term investment returns. And lastly, we let them compound. We're patient. Our portfolio turnover is low, very low, in fact, less than 10% a year. To quote the late Charlie Munger, the big money is not in the buying and selling, but in the waiting. Buy the best companies, buy them at the right price, let them compound. It's that simple and it's that hard. Next slide, please, Dan. On the left, we present our top 10 return contributors for the year. On the right, you'll see the top 10 return for the equity. All the usual suspects are there: Nvidia, Microsoft, Amazon, Meta, Alphabet. In the last year, how many times did you hear active managers say, we didn't own Nvidia, or we had too much Tesla, or Apple will come right, or you've got to own the Magnificent Seven, or many other reasons for not beating the benchmark? Now, we are not trying to bash the Magnificent Seven here. It's just that the idea of having to be invested in the biggest stocks in the market in order to beat the benchmark is just not borne out by the data. For the 1 year to June, 30% of stocks beat the equity benchmark dollar return of 23.3%. That's 1 in 3 stocks. 900 stocks out of a 2,700 stock benchmark gave you a chance of beating the benchmark. Those are good odds. I'd take them every time. Even on a 3-year CAGR basis, the benchmark hurdle rate was only 5.7% in dollars. There, over 3 years, 29% of stocks beat the benchmark dollar return. Those are also good odds. Now, with that in mind, let's take a look at our top performers. For the most part, our top performers were not the Magnificent Seven or the weight loss drug companies Eli Lilly or Novo Nordisk. For the record, these are great businesses. We, in fact, own 4 of them. But outside of owning Facebook, Google, and Bookings in our top 10, I would think that the man on the street probably hasn't heard of any of our other top 10 businesses. Our quality-focused, profitable growth investment philosophy guides us to own great businesses for the long term. That means We don't have to be right on any particular investment theme or market positioning for that matter. Moreover, our approach delivers diversification. That means better returns with lower risk. Let's look at our top three: Arista, Deckers, and Pro Medicus. Next slide, please, Dan. We've owned Arista since the launch of our fund in December 2020. This chart is the relative performance for Arista compared to its largest competitor, Cisco Systems, and then also the ACWI benchmark. Arista has delivered 380% for us, call it 5x over 3.5 years. For comparison, the benchmark did 32% nominal, and Cisco, its competitor, lagged the benchmark, delivering only a return of 18%. This is a massive divergence of returns. What is it about Arista that has made it such a wonderful investment for our clients? Next slide, Dan. Thank you. Let's start at the beginning. In 2004, Arista was established by a group of former Cisco engineers. The business listed in 2014. Today, it has a market cap of about $105 billion. At the heart of the departure was a divergence in views regarding the technology roadmap and the evolving architecture of the internet that would enable the proliferation of data centers that today makes every aspect of your and my digital lives possible. As the story is told, Arista was and remains on the right side of history. Arista's offering is accepted as the leading technology platform for hyperscale data center networking. This open standard technology was developed in collaboration with the cloud titans and uses machine learning to intelligently route network traffic to and from data centers, amongst data centers, and now also within data centers. But the best hardware in the world is not enough for these intelligent hyperscale data centers. Arista also provides the unified network software management tools that allows clients to manage their entire network, irrespective of what equipment or where, on a single pane of glass. The relevance of Arista's offering has resulted in impressive growth numbers. The end market in which Arista operates is about $155 billion annually. Cisco, the lumbering giant in this story, accounts for about a third of global sales with $55 billion in sales annually. Arista only has $6 billion of annual revenue presently, but that's not the whole story. It's changing quickly. If you look at the bottom right chart, things are pretty much flatlining for Cisco. Despite $250 billion of cloud capex in the next year alone by the cloud titans, Cisco is not gaining market share. In fact, they are tragically retrenching personnel as we speak. By comparison, Arista is growing revenue at 20% per year. When we consider the profitability, this is the top right chart, Arista is quite clearly more profitable and a more productive user of capital. As Arista scales, so too does its profitability. In the most recent 12 months, ROIC, return on invested capital, has passed 32%. In the case of Cisco, things are going backwards. ROIC is now down to 17% compared to the 5-year average of 22%. For one, the sun is rising, and for the other, the sun is setting. From an investment point of view, the key challenge for us as investment professionals is to identify businesses that are profitable and growing in very large end markets, and crucially, where profitability is accelerating. Accelerating profits on a slow-growing capital base deliver an ever larger stream of excess profits. For the long term, quality investor, this is manna from heaven. One last thought on this topic. Markets reward profitable growers. This is borne out by the investment return data. Dan, next slide, please. Next up is an old friend. On a previous webinar, we spoke about Deckers Outdoor. We bought Deckers in July 22. To the end of June, give or take 2 years, we've done about 270%. Now, Nike, a former darling of the investment world, has in fact fallen 23%. Not owning Nike would have been a good thing for your clients. Over the same period, the benchmark did 39%. Next slide, please. Let's recap. What does Deckers do? Deckers owns the niche running shoe brand called Hoka, and the Aussie ladies fashion boot called UGG. These two brands are growing quickly, about 20% in the most recent year. Hoka is, however, where all the action is at. Hoka, along with other niche brands, have been taking market share from Nike. This much is evident in the expected growth numbers. Take a look at the top right chart. Deckers is likely to grow revenue by about 12% next year, whereas Nike will probably fall by about 5%, a 17% divergence. Growth aside, Deckers is also highly profitable, more so than Nike. Two trends have supported the recent success and rapid growth of Deckers versus other large branded players like Nike, Adidas, and Puma. Firstly, COVID accelerated the direct-to-consumer trend. Small and niche players could grow in a very capital-light manner, whereas large established players distributing through wholesale and their own bricks and mortar stores had to fundamentally reorganize their entire supply chains and marketing organizations. Secondly, the flexibility and ubiquity of global supply chains also meant that consumers could easily access niche brands that better met their needs and expectations. In our hyper-personalized world, niche brands have become a real competitive threat to large monolithic brands. Deckers successfully capitalized on these two market developments. Now, back in early 22, when we, as investors, we were most excited when we found Deckers. Two things stood out. Firstly, our investment process was able to identify the accelerating growth of Hoka. 28% of sales in March 2022 compared to 44% of sales today. And secondly, we could buy this business at 14 times forward earnings compared to Nike at 27 times. That's the bottom right chart. At the time, this was now when we considered the investment, Deckers was already growing faster than Nike, was more profitable on a gross, operating, and net margin basis, and was earning higher returns on invested capital. When you find a high-quality, profitable, growing business like Deckers at a very attractive valuation, you do the right thing. You buy it. Great things tend to happen to rational investors. Not only then do you get the underlying business growth over time, but your investment return is compounded by the valuation uplift. 4x in 2 years is a tidy return. Next slide, Dan. Thank you. Let's look at ProMedicus, PME for short. We bought this business in 2022, end October. This is truly a unique and exceptional business. It's not in the benchmark, so most investors are unlikely to find such a company by conventional means. It's listed in Australia, does its R&D and product development in Germany, and sells its services by and large in the US. We bought the company for 55 Aussie dollars. This morning, after strong results, it's at 142 Aussie dollars. The market cap presently is about 13.7 billion Aussie dollars or 9 billion US. In the 20 months that we've owned this business, we've done about 170% in USD. The benchmark delivered 41%. Next slide, please. What's the backstory here? PME is the sole player globally and the technology leader in cloud-based radiology imaging. PME provides hardware-agnostic software that connects radiology tunnels made by Siemens, GE, Philips, and others to the cloud. It takes the examination data from CT scans, CAT scans, MRIs, and uploads it to the cloud, rapidly processes, renders it, and then distributes these inordinately complex images. Traditionally, you'll see radiology tunnels installed at hospitals with co-located proprietary computer workstations that process and render these massively complex scans. This takes a lot of time and local processing power. PME's exceptional advantage is that it dramatically improves the speed, efficacy, scale, cost, and distribution of these extraordinarily complex 2D and 3D radiology images. As an example, certain critical oncological examinations are routinely omitted by radiologists because the on-site processing and rendering of these images takes more than 4 hours. PME renders these images in high definition, ready for distribution, analysis, collaboration to any computer, tablet, or smartphone anywhere in the world in less than 6 seconds. 4 hours down to 6 seconds is quite something. This is a massive, massive productivity gain by an order of magnitude. One happy consequence here of course, is higher tunnel utilization rate and an increasing number of prescribed examinations, and then also the increasing complexity of the types of examination. AI is also a big thing here. PME has not even begun to market its capability in AI-supported interpretation of these scans. Once deployed, this AI-led decision support capability will dramatically improve the accuracy of interpretation, lead to better diagnosis and health outcomes, and seriously drive further growth and profits for PME. In the US, PME's largest market, the company processes approximately 7% of the 600 million annual radiological examinations. That is almost 2 examinations for every man, woman, and child in the US every single year. Elsewhere in the world, the company has not really begun to market its cloud tools. Every time an image is processed, PME clips the coupon. This is an extraordinary story. Revenue and profits are growing at over 30% per year. Through the income statement, gross profit margin is 99%. The operating margin stands at 67%, and the net margin is 49%. Every single dollar of revenue turns into 49 cents of after-tax profit. It's truly astounding. Return on invested capital, despite paying out 50% of earnings as dividends, touches 50%. Years of profitable growth lie ahead. We consider ourselves most fortunate. We got in on the ground floor. Next slide, please. This morning, we've shown you some of the winning ideas that our philosophy and repeatable process generates. Now, if we follow our process assiduously, what portfolio do you get? If you attended the BCI Global Conference in May, you would have seen this slide. The table on the left presents a scatter plot of the equity. The vertical axis shows the median 5-year revenue growth rate for the equity, which is about 9%. And the horizontal axis, the median return on invested capital over the last year, which is also about 9%. The portfolio on the right is ours. Our businesses have grown 55% faster, 14% versus 9% for the benchmark. And our companies are 3 times as profitable, with a ROIC of 30% versus 9% for the benchmark. The underlying profitable compounding of our portfolio is simply better than the market. To finish off this morning's webinar, we believe our quality approach will provide long-term investors with above benchmark performance in hard currency at much lower risk. But action is what matters. The Mazi BCI Global Equity Fund is open for investment, and at 80 basis points all in, we offer compelling first quartile hard currency performance that you can stand behind with confidence. If our quality and repeatable investment process resonates with you, please get in touch. Thank you again for your time and interest.
Andreas, thank you so much for that. Insightful indeed. A couple of very quick questions. First one from Sean de Bisson. How benchmark aware are you or not in your portfolio construction, and what is your active risk? We know your benchmark is the ACWI or the MSCI All Country Index. How benchmark cognate are you?
We are not at all. We're bottom up. Our active share is 89%. And so we have a tracking error that's probably about 3 to 4%, but because we're benchmark agnostic in that sense, it really doesn't matter. We try to find the best companies in the world that are growing quickly and are deeply profitable.
And I think you've showed that in your first slide as well. If you look at your fund holdings relative to the MSCI, very different indeed. I found the one slide on Dekkers particularly interesting. If you look at the growth in earnings, and we all know, if a company grows, earnings price will follow. But interesting, next financial year, Dekkers drop growth in earnings from 20% to a projected 12%. Are you concerned about things like that? And is the price sometimes not running ahead? And if you see a drop in earnings, or is those still positive, could that have a negative impact on price?
We're long-term investors, so we're not too worried about the short term. In terms of the growth outlook for the company, our most basic yardstick is US or global GDP. So if that's about 2 or 3% and a company does 12%, then then we feel pretty good about growth. All sectors and all industries go through cycles. So if something has a very high growth rate for a period of time, and there's a bit of a cyclical downswing, it affects everyone. So that doesn't concern us. The thing that we are more interested in about is on a per share basis, how much free cash is being generated sequentially, and that continues to go up. The return on invested capital for Deckers keeps on going up. So even though they're only growing 12% top line, that return on invested capital has now jumped from 28% to 35% in the last set of results. And even with 12% growth, it's going to go up more. And the company's value is a function of the PV of all those free cash flows. So that's what we want.
Yeah, and we've heard it before. If you grow earnings, then the money will come. In finding those companies is the key. I'm going to try to cover two questions in one, and it almost speaks to the pond that you're fishing. Is it only DM that you look at, developed markets, or do you look at EMs as well? And what is your view on EMs?
We look at the whole world. We don't DM EM. We look at what is the likelihood that you can beat, let's say, 10% in dollars or 9% in dollars, give or take the long term. Well, the equity long term is actually 8% in dollars or so, but that you can beat that by a substantial margin. And that's where we fish. Right now, for all the EM players, India is looking amazing. We haven't spent the time and effort there, but we certainly got the diagnostic tools to see where we should be fishing. And so we continue to uncover interesting opportunities wherever they may be in the world.
Not walking around with blinkers, indeed, finding those opportunities. Andreas, thank you so much for joining us this morning.